Okay, I would like to start today's video a little differently. Let me just show you a TikTok video that I recently shared on the well-known short video platform.
I have $50,000 in my savings account. What should I do with it?
Well, depending on your job and your family situation and whether you have multiple sources of income, you most likely only need to keep 2 to 6 months worth of essential expenses. Overfunding your emergency fund has significant drawbacks, as cash is a terribly performing long-term asset class. Putting too much money at low interest rates into your bank account means you're actually losing money over time due to inflation. So instead, put your money in assets that can earn a return exceeding the rate of inflation. And in my view, stocks are by far the best long-term asset class to build true wealth. So as this clip highlights, everyone who is reasonably financially educated will know that cash is a terrible long-term asset and that cash sitting in your bank account will lose real purchasing power over time. So it's much smarter to invest your money in asset classes that beat inflation, that are able to generate a real return. Those are first and foremost productive and cash generating assets, such as stocks, real estate, corporate bonds, or government bonds. And you might know that I'm a big advocate of stocks, as history suggests that stocks are by far the best wealth creating vehicle available both to institutional and private investors, outperforming every other asset class if you consider a long enough time period, as highlighted by this chart from Jeremy Siegel's book, Stocks for the Long Run. But what if I were to tell you that stocks are actually a much worse investment than this graph may suggest? This will be the topic of today's video, and so without further ado, let's get started. As shown by the Jeremy Siegel graph shown in the intro of this video, over the long run, stocks have absolutely crushed all other asset classes. This is also confirmed by other analyses such as the numbers presented by the Stern School of Business and S-Word Demodemeran. What these numbers do not reveal, however, is that only a select few stocks are responsible for this extraordinary performance. Let me present you a few interesting data points. Essentially, the returns of individual companies of a broad stock market index are positively skewed, meaning that only a select few stocks contribute meaningfully to the total return of the index. Put differently, a positively skewed distribution means that most values are clustered around the left tail of the distribution, while the right tail of the distribution is longer. According to data by the S&P Dow Jones Indices, and I will quote their research here, for the 20 years ending in 2022, the median return of S&P 500 members during their index membership was 93%, far below the average return, which was 390%. Only 31% of the index constituents outperformed the average stock. And this phenomenon is then illustrated in a chart. Now, similarly, MAP Faber's research showed that between 1983 and 2006, 25% of all stocks delivered all of the gains. 4% of stocks lagged the Russell 3000 by at least 500%, and 39% of stocks were money-losing investments. And finally, another study that confirms this trend, Hendrik Bessembinder highlighted in his paper, Do Stocks Outperform Treasury Bills? That, quote-unquote, the best performing 4% of listed companies explain the net gain for the entire US stock market since 1926, as other stocks collectively matched treasury bills. Moreover, just 5 stocks, namely Apple, Microsoft, GE, IBM, and ExxonMobil, account for 10% of the total wealth creation in US stock markets between 1926 and 2016, which is summarized in this chart right here. And the numbers get even more striking. To quote from the paper again, the 90 top performing companies, slightly more than 1/3 of 1% of the companies that have listed common stock, collectively account for over half of the wealth creation. The 1,092 top performing companies, slightly more than 4% of the total, account for all of the net wealth creation. That is, the remaining 96% of companies whose common stock has appeared in the CRSP data collectively generate lifetime dollar gains that matched gains of 1-month treasury bills. And the great Charlie Munger is very aware of this phenomenon too. to quote the legend here. If you took our top 15 decisions out, meaning the decisions of Berkshire Hathaway, we'd have a pretty average record. It wasn't hyperactivity, but a hell lot of patience. So why do I present these numbers to you? Well, let me assure you, I'm still a big believer in stocks, and I think they are the best vehicle to build tremendous wealth if you have a long-term investing horizon. However, it is well documented that most individual stock investors actually underperform broad stock market indices, and they are even underperforming worse performing asset classes, mainly because of their lack of stock picking abilities and their ignorance when it comes to constructing a reasonably diversified portfolio of high quality stocks. Owning more and high quality stocks in the portfolio means that you will have a higher probability of owning the right stocks, the stocks that appear on the right tail of the distribution. If anything, I think the statistics presented show that your stock picking abilities are even more important than you may have thought. Not only do many publicly listed companies struggle to provide a positive return over the long run, now in fact a lot of companies actually do not survive over the long run. They go out of business and deliver a negative return. Now, as an active investor, you want to avoid these companies, of course, the companies that are struggling. And to do that, you will need to be able to read financial statements, and you need to be familiar with key financial metrics to be able to avoid poorly performing businesses and stocks. Of course, you will make mistakes. Don't be fooled and believe that you will successfully avoid all negative returning stocks, but you can increase your chance of avoiding losers by not investing in stocks that struggle to grow, that are unprofitable or hardly profitable, stocks that carry too much debt, or stocks that are facing secular headwinds, to name just a few examples here. And I think good investors, they continuously monitor whether their businesses, the businesses in their portfolios, are still on the right track, and they try to avoid everything to avoid the typical pitfalls of long-term loser investments. At the same time, as we have learned, a few stocks end up being big winners, and they will contribute massively and meaningfully to the overall performance of your portfolio. As an active investor, it is your job to try to find these stocks to increase the chance of having exposure to these outperformers. You can increase your odds of finding these businesses by looking for stocks that trade at reasonable valuations, that achieve above average returns on their investments, that have a sound balance sheet, that are growing at a reasonable rate, companies that have done well in the past and that thus have a good track record, because winners usually tend to keep on winning, companies that are profitable can thus finance their investments internally. Again, just to name a few examples here. To sum it up, we can reference Charlie Munger again, who said, "A great business at a fair price is superior to a fair business at a great price." In addition to a focus on stocks valuation and the analytical business framework that we have just outlined, you need another ingredient to increase your odds of building wealth via stocks, and that's patience. Patience is your major edge in stock markets, as very few investors have the mental fortitude to hold a well-performing business if the price is incredibly volatile. Again, as Charlie Munger has put it, sit on your investing. You're paying less to brokers, you're listening to less nonsense, and if it works, the tax system gives you an extra 1, 2, or 3 percentage points per annum. So there you've got your winning formula that Terry Smith has so nicely put in the following 7 words. Buy good companies, don't overpay, do nothing. You get the best chance of outperformance if you are able to set up a portfolio of high quality firms that you bought at a good price and that are likely to deliver outstanding returns on invested capital over the years. You invest in these businesses when they are available at fair prices, and then you just leave them alone over an extended period of time.